You know, the retail sales number has to be viewed in a multi-month frame perspective. So we had really nice revisions to July, but we were disappointed with August. But when you view them together, it isn't so bad. Yes, the number could have been a bit stronger. As far as what's going on with the dollar, it seems so counterintuitive that our central bank is trying to normalize, raise rates. There's at least several more in the pipeline, all things being equal. The balance sheet runoff is starting to gain a bit. And after the end of this month, as we get into October with the ECB, you're actually going to make a difference. The liquidity from these central banks is truly going to begin to taper. And I think all of that should reflect on higher rates and most likely a higher dollar. But if you take many of the issues Mr. Rutledge discussed and you look at how expensive it is to have a dollar and to hedge a dollar, that ultimately the perversion here is that what's going on with Europe's central banks dragging their feet, in essence, may actually cause the dollar to be more on the soft side. And finally, with regard to China, I get all these issues, even though the Feds around the world, the central banks are praying for inflation. The kind of inflation that we're discussing that could come out of the tariffs, I guess, is the wrong kind. But I'm more in Tepper's camp. In the grand scheme of things, I worry that the yuan gets cheaper and the dollar gets stronger, and that what we actually see is a lot more deflationary pressures in the years ahead exported by China into the U.S.
David Darst, nice to have you here at the top of the hour.
Nice to be here, and it's nice to see you, and it's nice to be with you, both of you.
So tell us how you're feeling about trade, and are you surprised to see the major averages looking set to end the week up almost 1% or more than 1% for the NASDAQ, given some of the uncertainties that still lie on the trade front?
Great point, Sarah. I think the market's been able to shrug off four things: the strong dollar, driven by interest rates, the average hourly earnings being up 0.4% for the month and 2.9% year over year. The last time that happened in February, it caused a big market sell-off. The third thing the market's been able to shrug off is this waning and wavering China and Europe. They're both showing slower rates of growth, as Rick just mentioned. And lastly is the emerging markets saga. The Wall Street Journal's lead editorial this morning was about they're culling the herd. They're just going after Argentina and Turkey. It's not spilling over to the others. So those are the four things the market's been able to shrug off. Profits is still a profits-driven market. The big thing you want to keep an eye on is the 6-point David Darst checklist for a bear market. Is the Fed tightening? Slightly. Or is a recession coming? No. Okay. Is investor euphoria present? Aside from a few tech stocks, not really. Are valuations excessive? They're on the expensive side, but they're not excessive. The last two are the banks, small caps, and transports underperforming. No, the small caps and transports are outperforming, Sarah, and the banks are underperforming a little bit because of this interest rate spread issue. And finally, our bond yield spreads tightening or narrowing, and they have not started to open up yet in a big way. So far, you don't have the ingredients there for a bear market, but you do have some ingredients there for a correction, which is a 10% fall, and that's something that could be driven by tariffs.
Janet, we've seen a big market rally, of course, over the last year or so, and we're hovering around those levels. Do you continue with the momentum names that have brought us there, or rotate at the moment?
Oh, absolutely. You got to continue with what's working. I'm glad I followed David. It's got to be, you know, it's a lot more fun to be optimistic. It's also more profitable. But yeah, you know, markets are going to react to the daily news. By the way, it's no surprise that the tariff news came today, right? Probably a distraction from the Manafort plea. I'm still hopeful that a deal may be negotiated, and no one really knows. So the best we can do is really identify what's working now, which continues to be U.S., although I guess Europe had their first positive week this week in a long, long time. But large cap domestic growth. Some small caps are coming up the ranks. But yeah, we're absolutely staying with things like IWF, IJT is a holding, and FDN. Tech is still strong. So stay with what's working, but have a plan for when things change. Of course they're going to change. Of course there's going to be a correction. We should have our portfolios positioned so that we can withstand several 10% sell-offs and a bear market in the next 3 to 5 years. Now I think is a good time to de-risk a little bit.
To have a risk on but balance. Okay, guys, thanks very much. David, Janet, and Rick, have great weekends.
Want to wish everybody an easy and meaningful fast next week on Yom Kippur on Wednesday. Take it from a graduate of Christ the King grade school.
There we go. David, thank you very much for that.